So Brexit, the Fed, the much anticipated phase one deal, all moving markets, maybe not in the order of importance you think. We'll discuss that and what it means moving forward. So we're going to go through the three big news items where we actually got some clarity this week. The UK elections, i.e. Brexit, the Fed meetings, and of course this phase one Trump Accord. But I'm going to start in a little bit different order that I find more important than what you're likely to hear on the nightly news this evening. First of all was the UK election yesterday. Certainly the most shocking result. It definitely puts Brexit on the table as Corbyn and the Conservative Party, and their desire to pull the UK out of the Eurozone, won a dominant majority, their biggest in almost 40 years, their first this century. And much like the election in 2016, it also signals there's going to be at least no tax increases, if not perhaps tax decreases, as well as a more business-friendly, i.e. less regulation of business environment in the UK. All of which should, politics aside, be very stimulative to the markets within the UK and the Eurozone over time, much like they were here. Certainly trade and whether the U.S. refocuses on the Eurozone in general are still on the table, as well as the global impacts of a phase two, phase three trade deal with China. There's still some details to be worked out, of course, on those Brexit terms, but we're much, much more clarity. And at the end of the day, that's what the market really needs to see. Great opportunities abound. We may or may not know of a top percentile fund with a 7.5% dividend yield that hasn't had a short-term gain since 2007, but I digress. Step two was the Fed. A bit ironic, certainly saw the sad passing of Paul Volcker, although at the nice age of 92 years of age. He, of course, helped break the inflationary cycle of the 70s and was the head of the Fed from 79 to 87. And in the same week that this inflation hawk passed on, we had Powell, current chairman, come out and basically say that even though inflation's ticking up at a 13-month high, they're on hold for all of 2020. Now, this was going to be the year of two hikes that turned into the year of three cuts, so anything can happen, but this was maybe the most bullish event in terms of equity markets moving forward that happened this week, in the sense that for the first time in a non-crisis type situation, you had the Fed come on record and say, we're not hiking, and left open the possibility of potentially even cutting, although their plan is to stand pat in 2020. And when you look at the relative, again, strength of the market, albeit there's a little bit of a slowdown going on, and inflation spiking, and the fact that the Fed itself is usually the thing that has stopped economic cycles in the past outside of debt bubbles, this is, again, very accommodative and should, over the long term, i.e. 12 to 18 months, be pretty stimulative to markets. So the biggest news in the sense of what's dominated the headlines was obviously the pending tariff deadline of December 15th, this Sunday, and would a phase one deal that had been announced in October actually come into fruition? So by most accounts, yes, it did, although there was a few questions about even that today. But the two sides have in fact come to agreement, and that catalyst is off the table. It's supposedly a huge deal, but it's pretty small in details, and that is what will really be interesting to come out. At least what we understood of phase one, meaning what everyone had been told, was really not that big of a deal. So it'll be interesting to see if there's anything new and really just kind of reset some of the things where there had been tariffs back to pre-conflict type levels, which in and of itself is not going to be stimulative of economic activity outside of investor sentiment and CEO sentiment, which is currently pretty low. That sentiment, that catalyst that we've certainly seen play out over the last couple months is gone now. As a phase two, phase three deal, something with significant teeth around intellectual property is highly unlikely to happen in 2020, if ever. So now it'll come back to real relative rates of change within economic data, corporate earnings, which if we take a quick look at that are pretty mixed, if not still slightly negative. You had U.S. jobless claims after the great number last week spike up 18.3% year over year, up 50,000 claims. You've got ISM manufacturing data still mired at contraction type levels. The service sector still in expansion, albeit weakening and disappointing expectations this week. And of course, consumer confidence up, but again, the rate of change negative 8% year over year, coupled with that CEO sentiment that's down. So how do we put this all together into something that's actionable? Well, at the end of the day, again, we're back to really fundamental analysis, at least for the near term, which I think is a positive in the sense that it should provide investors more clarity. Where that could be a potential negative again is those numbers still look pretty soft into Q1, Q2 of next year. We've got markets trading at relatively elevated levels in the near term. And the hype, the headlines around trade that has buoyed markets is now gone. And you saw that even today as a microcosm of what might lie ahead in the first 6 months, which is kind of an initial spike and then a little bit of a fade. And so back to fundamentals, back to what's going to drive. The good news is we still think 2020 can be a great year, albeit we would caution that investors seem to be at this level by sentiment indicators and other anecdotal type measures to be underestimating potential volatility in the first part of the year. So keep that in note. And of course, as we talked about last week, there are ways to mitigate volatility and again, build a plan and a portfolio that can work and work for you even when markets aren't. So with that, we hope that helps pull some of this together. And we look forward to hopefully seeing you tonight at the holiday party if you're here in town. Thanks so much.